It's the tech retail king. Everyone knows COM7 is the #1 Apple retailer in Thailand. But, in an era where the new iPhone model might not be as exciting as before, can COM7 still drive growth? Through non-Apple and IoT products. Will the Q368 profits meet expectations? And will the strategy of opening every brand in every location truly mitigate the risk of over-reliance on its core product? Today, we dive deep into COM7. Hello, and welcome to the Deep Dive. Before we jump into the numbers, we really need to set the scene here. We've got a massive stack of sources today. The latest earnings just released this week, some really deep dive brokerage reports, and long-term strategic analysis of what management's aiming for. Our mission is crystal clear. We're assessing the Q368 report card, which, just for our international listeners, that's the third quarter of the Buddhist calendar year 2568, so 2025. But maybe more importantly, we're trying to figure out if COM7 is successfully transitioning.
Moving from what was historically, a volatile, cyclical IT stock one tied entirely to when people decide to replace their phones into what management keeps calling a snowball business.
That is precisely the core conflict, yeah. And the source material, well, it lays it out beautifully. If you're an investor looking at this, you're basically watching two very distinct narratives unfold. The first narrative, it's the continuation of their highly profitable, but let's face it, predictable core IT retail business. That relies on really strong execution and tight margin control. Then there's the second narrative, and this is the aggressive push into new, highly capital-intensive S-curves. We're talking specifically EV taxi rental under that EVXY banner and residential solar installation. The market right now is trying to calculate if that second, wildly different narrative will fundamentally change the company's revenue mix, accelerate growth, and ultimately raise its valuation ceiling. If they pull it off, it genuinely becomes a snowball business growth that sort of compounds, accelerates, and sustains itself, making it far less sensitive to the ups and downs of the yearly iPhone cycle.
Right, that distinction, cyclical pump versus compounding flywheel. That's crucial for you, the listener, to grasp. Okay, let's unpack this then. We have to start with the baseline. Q368. What were the hard numbers the market was waiting for? And crucially, did COM7 deliver on its reputation for execution in what can be a pretty challenging retail environment?
Well, the Q368 financial results, they came out on November 12th, 2568, and honestly, they were exceptionally strong. They lined up almost perfectly with what the high brokerage expectations were. And that's critical, because hitting a high expectation, well, it really demonstrates superior operational control, doesn't it?
Okay, so what were the specifics?
Specifically, the net profit came in at 872.03 million THB. Just for context, the Thai baht THB is the local currency. And 872 million THB, that's a substantial increase year over year. It was 709.52 million THB back in Q367. Earnings per share, EPS, also saw a healthy jump, up from 0.30 THB to 0.37 THB year on year. YOY.
That YOY growth is pretty impressive. And I noted that the big brokerage firms, like BLS, they had forecasted net profit around, 878 million THB.
Yeah.
So being within that narrow range, it confirms two things, right? Management's guidance was accurate, and their execution was, flawless. They made consensus. No major surprises. Exactly what stability-seeking investors like to see.
Absolutely. And when you look at the cumulative performance, the momentum is just undeniable. The profit for the first 9 months of 2568, it's already hit 2.85 billion THB. That's up significantly from 2.29 billion THB in the same period, 9M67.
Wow. So they're well on track.
Very much so. To put that 9-month figure in context, it already accounts for a robust 72% of the full year 2568 profit estimate. That estimate was 4.05 billion THB, the target set by BLS. So this points to a very healthy growth trajectory heading into Q4. And Q4 is typically their peak season, driven by new gadget launches, holiday shopping.
Okay, so volume growth is definitely there. Execution is tight. But as you pointed out earlier, growth shouldn't just be about selling more units. It has to be about maximizing profit per unit. So that brings us to the underlying drivers. How did they achieve strong same-store sales growth, SSSG, while also maintaining and even improving margins? Hashtag 1.2 factors driving growth and margin expansion, SSSG and GPM.
Right. The immediate drivers for SSSG and Q368 were pretty broad-based, actually, and high quality. We saw increased demand across the board for both the core Apple portfolio and, interestingly, the increasingly diverse Android devices. That already kind of supports the non-Apple diversification story. But there was a specific, more nuanced factor mentioned in the sources that really speaks to future trends.
Oh, what was that?
It was a measurable uptick in demand for equipment supporting AI.
AI.
Yeah, 'cause this isn't just a buzzword here. It's actually translating into hardware demand.
Wait, let's pause on that AI equipment trend for a second. That's fascinating.
Mhm.
What exactly does equipment supporting AI mean in the context of, an IT retailer like COM7? Are we talking specialized consumer chips, or is it something more mundane?
Primarily, we're talking about two things here: high-end devices and the ecosystem accessories that enable high-quality local processing. So firstly, the newer flagship smartphones, both Apple Pro models and those high-end Androids, they're basically the minimum entry point now for advanced AI features. Things like instantaneous language translation, complex photo editing, or running larger language models right there on the device. COM7 benefits as customers upgrade to the most powerful devices available.
Okay, they make sense. Needing the horsepower.
Exactly. And secondly, that the sources suggest an increased demand for peripherals, particularly things like high-speed memory, integrated storage solutions, and maybe even network gear, like those high-spec Wi-Fi 7 routers. Stuff needed to support seamless, cloud-connected AI applications, especially within that growing small home office, the SOHO market, where people are integrating more and more smart devices. It's a subtle but persistent revenue tailwind.
Got it. So growth isn't just tied to the replacement cycle anymore, but also the performance cycle. Consumers actually need the fastest processor to get the newest features.
Yeah.
Okay, now let's pivot to profitability. How did they manage to boost profitability in such a competitive retail landscape? That's the big question, isn't it?
It is, and this is where that strategic shift starts to show up, even within the core retail operations. This touches on the fifth point in our dive service and margin control. The sources reveal a significant anticipated improvement in the EBIT margin. That's earnings before interest and taxes, right? A critical metric showing how profitable the core operations are.
And the improvement was?
The EBIT margin was expected to rise to 5.7% in Q368. That's up substantially from 4.9% in Q367.
Wow, 0.8 percentage points.
That increase is remarkable in the low-margin commerce sector, almost a full percentage point.
Yeah, almost a full percentage point improvement YoY in their operating margin. That's massive for retail. That goes straight to the bottom line. So what specific levers did management pull to get that kind of margin expansion?
Well, the improvement in the gross profit margin, the GPM, and the EBIT margin, it boils down to two highly effective operational strategies. The first one is a favorable revenue mix shift. They're successfully generating a higher proportion of their revenue from high-margin services.
The add-ons.
Exactly. Those ancillary services that attach to a gadget sale. Think specifically of the financial services through UFund, we'll get into that more later, and after-sales care, like eye care insurance fees, extended warranties, that kind of thing. These services, they boast dramatically higher margins than just selling the physical iPhone itself, so naturally they improve the overall GPM.
Right, so every time a student finances their phone through UFund or buys an insurance plan, the profitability of that whole transaction jumps up, even if the hardware margin on the phone itself is still pretty thin.
Precisely. The second factor is just classic, rigorous operational discipline, operational efficiency, and cutting SG&A. They've systematically reduced their selling, general, and administrative expenses per store.
How'd they manage that?
Primarily through the pragmatic closure of unprofitable branches. Now, we're not talking about closing those big, high-traffic studio locations. The sources indicate the focus was more on pruning smaller, older, often low-footprint banana stores or maybe specialized accessory shops that were generating minimal returns, or where, frankly, the rent costs just outweighed the margin gains. It's optimizing their physical footprint to maximize the return on assets. Fewer, better-performing stores, combined with that high-margin service revenue, that's how they delivered that strong Q3 and the expanding margin story.
That's a great setup for our next section then.
No.
Because that operational efficiency and margin expansion are critical. Despite this success, the core business, well, it remains fundamentally tied to the massive cyclical nature of the IT product launch cycle. Okay, here's where it gets really interesting. We've established that COM7 is deeply tied to the Apple ecosystem. Let's try and quantify that reliance and talk about the inherent risk it poses to their valuation.
The numbers are pretty stark, yeah. Apple products account for a staggering 50-60% of total revenue.
50 to 60%.
Yeah, this concentration is their rocket fuel, absolutely. But it's also the source of the volatility that has historically defined this stock. The inherent risk is simply the cyclical nature of demand. Historically, the stock performance and revenue have been directly tied to the IT spending cycle. If an annual flagship release is a major hit, COM7 enjoys this massive revenue lift. But if the next iteration is considered incremental or less exciting, a so-called S year, revenue can fluctuate dramatically. This cyclical exposure is really what has capped the stock's PE multiple within a certain trading range for years.
But right now, they seem to be riding a massive boost. The brokerage analysis sources, they're banking on Q468 profit growing significantly YoY. Driven, they say, by the full quarter sales of the iPhone 17 and the associated new Apple devices. Why is this cycle looking so strong right now?
It seems to be a powerful confluence of factors, two macro ones and one micro factor. The macro factors relate to the device replacement cycle. Analysts believe the industry is kind of aligning with a longer, maybe 5-6 year device replacement cycle now. And crucially, that massive post-COVID spending peak that happened around 2021, well, that's now coming due, meaning a significant chunk of the installed base is ready for a replacement. That creates a natural demand wave.
Okay, the timing is right.
And the micro factor is the device itself. The iPhone 17, especially the Pro model, it's being considered a major hit, mainly because it addresses a fundamental shift in user behavior.
All right, let's elaborate on that hit status.
Yeah.
You mentioned it's driven by the surge in vertical video and content creation. How does the hardware specifically enable that better than previous models? And why does that matter so much to COM7's specific customer base?
Oh, it matters intensely. Because their customer base includes a large number of digital creators, influencers, small e-commerce owners, people who use their phones as actual professional production tools. The iPhone 17 Pro models, they introduced significant advancements. Things like sensor shift stabilization, much better low-light performance, and really refined cinematic mode feature.
Oh, the camera tech.
Exactly. But maybe more crucially, it's the software integrations and the sheer processing power. It allows for complex vertical video editing and rendering right there on the device with unprecedented speed. That efficiency gain is highly valuable to content creators. It makes the upgrade feel like a necessity and not just a luxury. And COM7 benefits directly from selling these high-margin Pro models to a demographic that treats the phone as essential business equipment. Hashtag 2.2, mitigating the cycle through store diversification.
Okay, so they're perfectly positioned for this iPhone 17 wave. But the underlying risk remains, doesn't it? The wave will eventually recede. And that's where the diversification strategy comes in, that opening every brand and every location concept. How does expanding the physical footprint actually mitigate the reliance on a single product cycle hitting high numbers all at once?
Well, the immediate strategy is about physical risk mitigation through aggressive branch expansion and brand diversification. The core goal is pretty simple. Stabilize the base revenue and hopefully the stock price, regardless of whether the next iPhone, say the 18, is a blockbuster or, well, a bit of a bust. The company is expanding its physical footprint significantly, growing from 1,312 stores at the end of 2,567 to a targeted 3,350 stores by the end of 2,568.
That's nearly 40 net new locations in just 1 year. That's quite a pace.
It is. That level of expansion is huge for market saturation. But the crucial part is the strategy behind it. It's not just opening 40 more identical COM7 stores, it's the variety of specialized sub-brands they operate. You've got Banana, which often covers broader IT, Android, IoT stuff. Then Studio, which is Apple-centric, iCare for service centers, and others too, all operating under this high-level policy of opening every brand in every location.
So blanketing the area with different options.
Exactly. This physical diversification ensures that even if one specific Apple device underperforms, the sales generated from Android devices, various IoT products, appliances, accessories, across their 1,300-plus touchpoints. It supports overall YoY and QoQ sales growth. It's basically revenue smoothing through physical scale and brand exposure. If the iPhone stalls for a bit, the Xiaomi or Samsung sales in the Banana stores can still pick up some slack, making the overall revenue line much steadier.
Okay, that provides a more reliable, growing baseline. But the management's real ambition, the part that really justifies that premium valuation target analysts talk about, is escaping the cyclical nature entirely, building that snowball business. Right, let's define that shift more clearly. When management talks about becoming a snowball business, what does that actually mean structurally for the company? How does it move beyond just fluctuating gadget sales?
Well, a snowball, in this context, it means moving away from relying purely on single transaction revenue, moving towards sustained, accelerating, and crucially predictable streams of income. It's about creating a sort of flywheel effect, where sales generate long-term financial relationships, which in turn provide reliable capital and cash flow for future expansion. And importantly, it's decoupled from the annual IT spending cycle.
And they're already making progress on this.
Oh, yes. We can quantify the existing success of this diversification. This addresses our second point, non-gadget businesses. That includes services, financing, smaller ecosystem sales. They already contribute a significant 30-40% of net profit and revenue.
30 to 40% already. That's quite substantial.
It is. It's already a powerful base layer, and the long-term target is to increase this contribution to 40% by 2028. If they hit that goal, almost half their profit will be recurring or predictable. That would fundamentally alter the valuation profile you see.
Definitely. And that transition, it seems, is built on a foundation of existing service capabilities. And the most important component of that existing snowball seems to be UFund, their financial services arm. How does UFund manage to lock in that long-term revenue and solidify its role in the non-cyclical strategy? Hashtag 3.2 deep dive into UFund financial services.
Yeah, UFund is really the poster child for how vertical integration can create a snowball effect within their current model. It started out providing installment loans, heavily focused on students buying iPhones and other high-value gadgets, particularly around university areas. That demographic is key, right? High gadget replacement frequency, but often lacking the immediate capital.
Start targeting.
Very. And critically, they've expanded rapidly since then. Now they're offering financing for other gadgets, accessories, even Android devices, which, again, further mitigates that reliance on just Apple. The impact is significant. The total loan portfolio has grown to over 3 billion THB.
Okay, let's break down that mechanism. 3 billion THB in loans. That means you're generating interest income and fees over several years, not just a one-off sale. This is where that snowball momentum comes from, right? Transforming a product sale into a kind of 3 or 4 year annuity.
Precisely. The key insight here is revenue predictability. This revenue stream is consistent because it involves long-term installment payments, typically spanning 3 to 4 years. Once a loan is originated, assuming the asset quality is maintained, that revenue stream is pretty much locked in. It minimizes those cyclical effects we talked about. The revenue comes from the interest rate charge, not from the next iPhone launch.
And this feeds back into the higher margins we discussed earlier, too.
Exactly. That higher margin service revenue includes the indirect income and fees generated from UFund. It's a core part of that GPM improvement story.
Okay, but what about the risk? How do they manage the operational risk of running a 3 billion THB loan book? Who's actually underwriting these loans, and what's their strategy for managing asset quality? I mean, specifically non-performing loans, NPLs.
That's a crucial question, absolutely, for any kind of financial venture. COM7 typically partners with established financial institutions for the underwriting side and uses its own balance sheet more selectively. But the competitive edge here, it really comes down to customer acquisition cost and asset visibility.
How so?
Well, think about it. COM7 leverages its enormous retail network, those 350 plus Sir Banana studio shops, to acquire customers for UFund extremely efficiently. They don't have to spend huge sums on external marketing trying to find borrowers. They're offering financing right there at the point of sale.
Ah, the built-in customer base.
Right. That operational synergy means much lower customer acquisition costs compared to traditional banks or lenders. And furthermore, they manage NPLs proactively. Their target audience, students, young professionals, generally has pretty good credit habits. Plus, the physical device often acts as a kind of partial collateral, although the primary control is rigorous screening right at the point of sale. By maintaining this asset quality while growing the portfolio rapidly, UFund really solidifies its role as a strong and non-cyclical pillar for the business.
Okay, so the existing model retail sales generating financing opportunities, which in turn generates long-term predictable income, that's already proving the snowball concept works. And it's accounting for, 30-40% of profit already? But the future, the big valuation unlocks everyone's watching. That relies on replicating this success in entirely new, non-core, and very capital-intensive verticals.
Right, let's talk about these big new S-curves. The ones analysts believe could truly break COM7's historical trading range. The first one is the EV rental ambition under the EVXY banner, moving from selling phones to renting electric taxis. I mean, that requires a profound leap in operational capability, doesn't it? Hashtag tag 4.1, the EV rental ambition, EVXY.
It really does. But this S-curve, it targets a clear government-mandated market need. In the coming years, somewhere between 30,000 to 40,000 conventional taxis are due to be retired or deregistered annually, just due to age or new regulatory requirements. That's a massive captive market that needs new vehicles. It's a forced replacement cycle.
Okay, so there's demand. Definitely. And the EVXY model is to offer affordable EV taxi rentals. The aim is to capture market share, traditionally dominated by small, local, and generally pretty inefficient cooperatives, what the analysts call the SME segment.
And the targets here seem incredibly aggressive. They need critical scrutiny, right? They're aiming to expand a current fleet of maybe 700, 800 cars to 3,000 cars by the end of this year. And the ultimate goal, 10,000 cars within 3 years. Wait, 10,000 cars in 3 years? That's not a retail finance company anymore. That sounds like a massive logistics, maintenance, and fleet management operation. Does the source material give any detail on how they plan to acquire the mechanical or fleet management expertise needed to maintain 10,000 electric taxis in a hot, high-utilization city environment?
That is the single largest operational risk for the EVXY venture, yeah. And the sources do acknowledge it. COM7 is planning to leverage its existing logistics framework. I mean, they are masters of moving high-value inventory efficiently, but they are also entering strategic partnerships for the maintenance side and for charging network management. They seem to be outsourcing the deep mechanical expertise while retaining control over the financing and the customer relationship. It's kind of similar to how they handle eye care services, right? The core strength they bring isn't fixing the car itself, it's financing it cheaply.
Okay, let's focus on that financing mode then. The competitive advantage based on the low cost of funds. Cough. Explain the mechanics of that difference. Why is that so important?
This is the real snowball factor for EVXY. Large listed companies like COM7, they have access to corporate bank loans at prime rates. They can often borrow at maybe 2-3%. Now contrast this sharply with those small local cooperatives they're trying to replace. Those guys often have to borrow at much higher rates, frequently 7-8%, sometimes more, just because of their smaller scale and higher perceived risk profile.
Right, a big difference in borrowing cost.
Exactly. That 4-5% differential in the cost of capital, that is the competitive moat. In a high capital-intensive business like vehicle financing, that difference translates to hundreds of millions of THB in savings when you're buying thousands of vehicles.
Okay, and how does that translate into savings for the actual taxi driver? Why is that so powerful in attracting them?
The savings are substantial for the driver. A lower COF allows COM7 to undercut the competitors' daily or monthly rental rates while still achieving a high internal rate of return and IRR on the asset, potentially above 20%. So if a small cooperative is forced to charge, say, 800 THB a day just to break even, COM7 might be able to profitably charge 700 THB a day.
Direct saving for the driver.
Yes. This immediate cost saving is the critical factor for recruiting drivers. And that creates a powerful network effect, or, a snowball. More drivers mean more utilization, better data, potentially better insurance rates. And look, if they hit that 10,000 car target in 3 years, this segment alone is projected to contribute a massive 15-20% of COM7's entire net profit.
15 to 20% from taxis.
This is huge diversification. It would effectively neutralize the volatility of the Apple cycle almost entirely. That's why the market views EVXY as the single biggest potential catalyst right now. Hashtag 4.2 residential solar rooftop.
Okay, that's EVXY. Now for the second S-curve. Residential solar rooftop installation, another completely non-IT vertical, but one that seems to share that core financing DNA we saw with UFund.
That shared financing DNA is absolutely the critical link here. The residential solar market in Thailand is vast. It's valued at multiple tens of billions of THB, maybe more. It's a major economic vector driven by both climate concerns and increasingly just the cost of electricity.
And what's driving the growth now?
Well, several catalysts are supporting this growth. Government deregulation has simplified the installation process for homeowners, cutting down on some of the bureaucracy. But maybe more importantly, global solar panel costs have plummeted. That drastically improves the economic payback period for the homeowner. It used to be a daunting 10+ years, which made it an unattractive investment for most people. Now the payback is much shorter, much more palatable.
So the product itself is finally financially viable for the average consumer.
Okay.
But how does COM7 leverage its retail network for this? I mean, why would someone buy solar panels from the same place they bought their smartphone? It seems a bit odd.
Well, COM7's strategy here is clever because it leverages two things: trust and omnipresence. They plan to use their massive retail footprint, those banana and studio shops, not just as places to sell phones, but as trusted local distribution points to sell solar cells and installation services. They're aiming to provide the full contractor service, but relying on the established local trust they already have from being a known high street brand.
Interesting. And the financing ties in how?
The model is basically identical to UFund financing. Customers can use the immediate savings from their reduced electricity bills to pay the installment cost for the panels and the installation. This often makes the installation cash flow neutral or even positive right from day one. It effectively removes that high upfront capital barrier that stops most consumers. It's essentially a recurring revenue installment model built on their financial expertise, just applied to a different physical product.
So it's still early days for this one.
Yeah, currently this solar business is still pretty small scale. The sources mentioned around 100 rooftops installed so far, but their advantage lies in their intent to use economies of scale, leverage that financing model, and use their existing high street presence to rapidly enter and penetrate the market. The goal seems to be to turn high street phone stores into broader energy solution centers over time.
Okay, what's fascinating here is both EV and solar are massive capital-intensive ventures, and they demand operational skills far outside COM7's high street retail core. This really feels like a high-stakes bet on management's ability to execute complex operations in completely new fields.
It absolutely is a profound strategic gamble, and the market knows it. The success of these two S-curves is currently not guaranteed at all, which is reflected in their current valuation, right? But the potential upside is immense. These projects represent the key to unlocking a significantly higher valuation ceiling for the company.
But the risks must be equally high.
They are very high. EV competition is fierce already. We see well-capitalized players like EV Plus, which is backed by the huge PTT group, establishing dominance, and the solar market also has many local and international players competing intensely. COM7 needs to demonstrate flawless execution and gain scale very quickly to establish a meaningful position in either market. If these S-curves fail to launch properly, or if operational costs like sleep maintenance for the EVs or ensuring solar installer quality control spiral out of control, well, the stock probably reverts immediately back to its previous cyclical IT dynamics, and that hoped-for valuation premium just vanishes.
So it really is a show-me moment for management then. They've delivered robust performance on the core business, that seems clear. But the future growth narrative and any significant multiple expansion is entirely riding on the successful execution of these two big non-core projects. Okay, so what does this aggressive dual strategy, strong core plus risky S-curves mean for you, the investor, right now? Let's try and summarize the valuation appeal as the market waits for tangible signs of execution on these new ventures.
Right, let's look at the latest metrics. As of November 13th, 2568, the stock price was hovering around 22.00 THB. It's been trading in a 52-week range between 16.70 THB and 28.00 THB. Now, crucially, the valuation looks pretty appealing relative to its own history, and that's where the opportunity might lie. The stock is trading at a PE ratio that's price to earnings, a measure of how expensive the stock is relative to its current profits of around 13.3x. That's based on the 2569 earnings estimate.
Okay, 13.3x on forward earnings. That PE context is essential, though. How does that compare historically? You said it's appealing.
Yes, because trading at 13.3x is significantly lower. The analysts say about 38% below its historical 5-year average PE ratio.
Right. 38% below average. Why is the market pricing them so low compared to their own history then?
Well, it suggests the market is basically pricing them as a maybe slow growth cyclical retailer right now. It's essentially ignoring the high growth forecast from the core business and treating those big S-curves as kind of a long shot fantasy until they're proven otherwise. The current trading PE based on the latest trailing numbers is about 14.89x.
Okay. And even though that current valuation, let's call it around 15x, is considered fair or maybe slightly inexpensive compared to the broader Thai commerce sector average, which typically sits between 15x and 18x, the market is clearly in a wait-and-see mode regarding the transition.
But the underlying growth outlook, just from the core business, remains robust, independent of the S-curves actually working out.
Absolutely. The core retail engine is strong. BLS, for instance, estimates earnings per share growth of 15% annually for both 2568 and 2569. So this combination of robust double-digit core growth and a relatively depressed historical multiple, well, it could provide a compelling entry point for growth investors who actually buy into the strategic diversification plan. The stock looks kind of cheap if you believe management can execute on these new ambitious plans, #tag 5.2 dividend appeal and target price. And there's another key part of the appeal, especially while investors are waiting for those EV and solar projects to mature and show results. And that's the dividend. The dividend yield provides a stable return floor, sort of paying you to wait while these ambitious projects develop. Okay, what does the dividend profile look like then? Is it attractive?
The dividend appeal looks strong, yes. The latest reported yield is 3.66%. Furthermore, BLS forecasts an even more robust dividend yield of 4.5% for 2568. They're projecting a dividend per share, DPS, of 1.05 THB. That level of yield is excellent for what's still considered a growth stock.
4 to 5% yield is pretty solid.
It is. And what's truly exceptional, really, and what speaks volumes about the financial health and the cash generation ability of that core IT business is the long-term dividend trajectory. The 5-year average dividend growth rate is a very strong plus 23.45%.
Wow, growing the dividend by over 20% a year on average.
Yeah, this combination of a high current yield and consistent historical growth makes COM7 look like an attractive retail leader for investors seeking both potential capital appreciation and some income stability while they wait.
And what does the analyst consensus say about its future price, given all this potential and the current valuation?
Well, the brokerage consensus, specifically looking at BLS again, maintains a firm buy recommendation. Their target price is 30 THB. Now, this target is based on applying a slightly higher, but still quite conservative, 16x PER multiple to the 2569 earnings estimates.
So still not pricing in a huge S-curve success premium yet.
Not fully, no. It's more based on core growth plus some S-curve contribution. And analysts explicitly suggest that the stock's recent 6% decline, which happened after those temporary dilution concerns over selling treasury shares to employees, they see that as actually an ideal opportunity for accumulation. The technical view seems to be that the market overreacted a bit to a temporary dilution issue, while maybe ignoring the strong underlying fundamentals and the long-term strategic potential.
Okay, so let's try and wrap this entire deep dive into a single conclusion then. COM7 seems to remain an attractive retail leader due to its strong core. But where does the real valuation upside truly lie? Is it still in the iPhone sales, or is it now in the car rentals and solar panels?
I think COM7's is currently priced predominantly based on its core IT retail business. And that core is performing excellently right. Strong organic growth driven by store expansion, successful margin management, and riding a successful iPhone cycle. The valuation multiple, around 15x, reflects this reality. Solid performance, but still viewed through that lens of cyclical constraints.
So the current price is for the old COM7?
Or largely, yes. The true upside potential is entirely inorganic. That potential, which analysts think could add a conservative 15-20% to the valuation, or maybe more dramatically, trigger a significant multiple re-rating, moving the PE from 15x up towards 17x or even 19x. That upside depends entirely on the successful execution and, critically, the rapid scaling of the EV rental and solar S-curves.
It all comes back to execution on the new stuff.
It does. Investors are currently in a holding pattern, effectively. They're waiting for COM7 management to provide clear, quantifiable signals, not just ambitious targets, but actual revenue contribution and proof of maintained asset quality from these new ventures. As we move beyond the immediate excitement of the Q468 iPhone sales and into the 2569 quarterly reports, the game really transitions from planning to execution. If they succeed in demonstrating that the EV and solar ventures are working, are scaling profitably, then that snowball effect will likely justify the higher valuation. And that leads us to a final provocative thought for you to consider. Given their strong cash position, their proven financial services expertise through UFund, and their extensive retail network, COM7 doesn't necessarily need to become the absolute #1 player in the fragmented EV taxi or residential solar markets to achieve its targets. If they only need to become, say, the strong #2 player, effectively stealing market share from all those smaller, less capitalized competitors with a higher cost of funds, how quickly could that financial snowball effect become visibly significant? Maybe even in the Q169 reports. And how much higher would the market be willing to price a company that is clearly not just selling phones anymore, but is also successfully financing key parts of the nation's energy and transport infrastructure transition?
That's the ultimate question, isn't it? That will determine whether COM7 truly breaks free from those Apple cycle constraints and becomes the compounded growth engine management envisions. We certainly hope this deep dive into COM7 gives you, our listeners, a clearer picture of the strategy behind expanding this technology retail empire. If you have any questions, or if you'd like us to analyze a specific stock in a future deep dive, please do let us know. Finally, don't forget to follow, like, and share to support our team. Thank you.